Welcome to vTalkInsight Allocator's Lens Daily for February 24th, 2026. Policy uncertainty around tariffs, AI-driven volatility, and rising geopolitical risk are colliding with resilient growth, creating a tricky cross-asset mix for portfolio allocators. Index-level moves remain contained, but under the surface flows are rotating aggressively across regions, sectors, and asset classes, so the risk and opportunity set is shifting fast. In equities, the dominant theme is rotation rather than collapse, as trade and policy uncertainty keep a lid on headline indices. Heightened concern over United States tariff policy after the Supreme Court decision, combined with threats of new 15% global tariffs, has pushed futures and major indices lower and lifted volatility, even though the broad market is still trading in one of its tightest year-to-date ranges on record. Beneath that calm surface, leadership is changing quickly. Equity performance is broadening beyond last year's United States large-cap growth winners, with cyclical sectors and international markets expected to gain ground as earnings and gross domestic product growth are projected to accelerate into year-end, while defensive sectors like energy, healthcare, utilities, and real estate are taking the lead as consumer discretionary and financials lag under tariff pressure. The tech and AI complex sits at the center of this transition. NVIDIA's upcoming earnings are seen as pivotal for both tech sentiment and the wider United States market, because a slowdown in AI-driven capital expenditure could quickly challenge the current productivity story and hit both equity valuations and bond yields. While at the same time, software and AI-linked stocks from IBM to other large platforms are selling off sharply as investors reassess business models in light of disruptive AI scenarios. At the same time, capital is edging away from United States concentration. Flows into non-United States exchange-traded funds are now outpacing domestic products. Asian equities in China and India are outperforming as potential beneficiaries of trade rerouting, and international equities more broadly are expected to outperform on weaker dollar support and relatively attractive valuations. Even as European markets wrestle with record single-stock dispersion and sector-specific weakness in technology. Private equity and major bank stocks are also flashing warning signs, with some names down mid to high single digits as tariff uncertainty and private credit concerns bite. For allocators, that makes this week's combination of mega-cap earnings, tariff headlines, and evolving sector leadership critical signals for whether the current rotation stabilizes into a broader equity advance or tips further toward a more defensive equity posture. Turning to rates, the picture is one of policy suspense rather than a clear trend. Federal Reserve Governor Waller has stressed that the March decision is still open, with incoming labor market data set to determine whether officials pause again or consider a modest cut, while market pricing is converging on an almost binary outlook between multiple cuts later this year or effectively none. Nominal yields are caught between disinflation and fiscal worries. 10-year Treasury yields have drifted lower by a few basis points toward the 4% area as investors sought safety on tariff and geopolitical headlines. Yet some fixed income managers argue that yields remain too low given sticky underlying inflation, large fiscal deficits, and long end supply, even as headline inflation is expected to trend toward the mid-2% range by year-end. Tariff dynamics add further noise. Economists estimate that earlier tariffs lifted core inflation by around 0.7 percentage points, and note that removal will be clearly disinflationary. But the Federal Reserve is expected to look through most tariff-related price moves as temporary, while bond traders increasingly watch equity tech leaders like NVIDIA for direction, highlighting how AI-driven growth expectations and policy uncertainty are now tightly linked in setting the yield curve. In credit, surface calm masks growing stress in private markets. Private equity firms are sitting on about $3.8 trillion of unsold assets. Distributions to investors are near their lowest levels since the global financial crisis, and fundraising has been weak for several years, leaving many funds wrestling with how to return capital while exit windows stay narrow. The strain is now highly visible in private credit. Blue Owl has frozen redemptions in a multi-billion-dollar fund and is selling assets to meet withdrawals, Other vehicles, such as OBDC2, plan large asset sales to return up to half of investor capital, and redemption halts plus secondary sales are raising fresh questions over liquidity and valuation across a roughly $1.8 trillion private credit universe. Yet there are pockets of enduring demand. Financing for data centers and other AI-linked infrastructure remains robust, as investors still favor long-dated, lease-back cash flows. But there is a notable sentiment gap between alternative managers who report resilient portfolios and investors who fear rising default and refinancing risk. A worry reflected in sharp share price declines for private equity managers and large banks that are exposed to these structures. On the currency side, the dollar is on the back foot. Futures in the United States currency are under pressure as markets digest the tariff ruling, global reactions such as the European Union suspending trade deal ratification, and the prospect of more policy volatility, all while broad-based dollar weakness coincides with stronger Asian and European currencies and renewed discussion of gradual de-dollarization. Capital flows reinforce that move. United States investors have been sending more money into international exchange-traded funds than into domestic ones, supporting the euro and other developed market currencies, and European authorities are now openly concerned that if the euro appreciates much further, especially beyond the 1.20 area against the dollar, it could accelerate the case for interest rate cuts in the second half of the year. These FX shifts have clear cross-asset implications. If United States equities underperform while the dollar weakens without sparking a broader volatility shock, international markets, particularly Europe and parts of emerging Asia, could continue to attract incremental capital, although large net short positions in the dollar may cap how far the move runs in the near term. Commodities are offering a mixed but revealing set of signals, starting with gold. Prices have surged roughly 6% in just a few sessions and are trading above $5,000 an ounce, with a move driven far more by momentum and financial flows than by traditional anchors such as real yields, inflation trends, or central bank buying, as investors respond to tariff uncertainty, a weaker dollar, and rising geopolitical tension around Iran. That leaves gold straddling safe haven and bubble narratives. On one hand, escalating legal and policy uncertainty over hundreds of billions of dollars in tariffs, plus the risk of United States military action if talks with Iran fail, underpin demand for insurance assets. On the other, the growing disconnect from fundamentals means there is no obvious catalyst to stop the rally in the near term, but also little valuation support if flows reverse. Oil is sending a different message. Despite the largest United States military buildup in the Middle East since the early 2000s and a looming deadline for Iranian concessions, crude prices are actually softer, with roughly a $10 per barrel risk premium offset by a persistent global oversupply, more than 4 million barrels per day of spare OPEC plus capacity, and expectations that Brent could average in the low 60s this year unless a temporary closure of the Strait of Hormuz disrupts roughly a quarter of seaborne oil trade. Industrial metals complete the picture with a more structurally positive tone. Copper demand is expected to remain strong as electrification, data centers, and grid upgrades accelerate, while supply is constrained, and producers like Freeport plan to lift United States output by around 60% by 2030, reinforcing North America's role in critical mineral supply, even as permitting challenges and calls for regulatory reform highlight how difficult it will be to match surging AI and reshoring-related metals demand. Putting it all together, equities are stuck in a narrow range, but hiding powerful rotations. Rates are caught between a credible disinflation path and noisy policy and growth signals. Credit looks calm on the surface, while private markets manage their toughest liquidity squeeze since 2008. The dollar is easing as capital looks overseas, and commodities split between a flow-driven gold surge, capped oil, and structurally tight industrial metals. For allocators, the key watch points now are the path of United States tariffs and related court battles, upcoming labor and growth data that will shape the central bank reaction function, the durability of AI-driven capital expenditure signaled by megacap earnings, and any escalation around Iran that could move oil and safe haven assets sharply. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.